We are here to hopefully have an interesting discussion on where the economy has been and where the economy is heading. And while I know politics and the economy are often closely related, our primary focus is on the economy. Many of you are in the business world, and almost everyone has either a direct or an indirect relationship with the business world. And we are fortunate to have Greg with us here today. Greg's addressed to discuss, at that time, the issues facing the legislature from a budgetary standpoint. And Greg addressed the now Senate President, Mike Herodopoulos, or was a guest of the next Senate President, Mike Herodopoulos. Many of you know Mike from down in Melbourne. Greg came and spoke, served on a panel, and has the incredible ability to take the dismal science, I think is what they call economics, and make it simple to understand. And so we've asked Greg to be here to talk about the economy, what he sees today. I know many of you all here in Jacksonville and Duval County, and certainly down in St. Johns County, we have some St. Johns County friends here, are grappling with issues at the local level. And so Greg's here to speak with you about a number of those things. He is, as many of you know, the U.S. economics editor for The Economist magazine. And so his focus is on the economy, financial markets, monetary and fiscal policy. And so he studies and writes and reads and speaks on those issues. He spent 2 decades in the financial and economic world of journalism, focusing on those issues. Spent 11 years with the Wall Street Journal before moving over, and has appeared on numerous cable television shows and numerous radio shows, nationally syndicated shows. And he lives, while he is Canadian by birth, he lives in Bethesda, Maryland. He is author of the book Economics, How the Economy Works in the Real World, and we have copies of that afterwards for purchase and for sale. And so I would ask you to join me in welcoming Greg Hill.
Thank you very much, Bob. Is somebody going to, okay, all right. And I'm just going to ask you to move the slides ahead. So just keep an eye on me. This is the second time I've had the privilege to address an event that Bob has been involved with organizing. Earlier this year was in Tallahassee at the legislature. I'm very impressed by the people you've got together for this one, including you, Mr. Mayor. I was wondering how Bob finds the time to do all this stuff and to put so many efforts into recruiting and organizing these great events, but I've actually now figured it out. He doesn't eat. I mean, it's the second time I've seen Bob sit down at a meal and not have a bite. So, Bob, please, eat something, okay? I'm getting worried about your health there. Okay, all right. All right. I can talk a little bit about where we are, how we got here, where we are, and where I can see us going. And I always have a lot to say. Unfortunately, never enough time to say it. So I'm going to, go through some of these slides fairly quickly. Okay, next slide. How we got here. First of all, next slide, please. The crisis began over a process of 25 years. It actually began before 2007, a period we call the Great Moderation, when we had the apparently wonderful combination of, back a slide please, of declining unemployment, declining inflation, just 2 recessions in that 25-year period, very mild. And they basically convinced us that the world had become a less risky place. And if the world seems less risky, what do? Well, you hold less cash, you take on more leverage, and you take more risk. And that kind of just sort of sets the tinder for the kind of crisis that we had. Another factor that contributed is what has come to be called the global saving glut. Now, for a country like the United States to borrow as much as it did, somebody's got to lend us the money. And that somebody was the Chinese, it was the Saudis, it was these other countries who were pursuing a model of export-led growth, which meant that they were selling stuff but not buying as much from us. They had to do something with the extra money. They lent it to other countries, primarily the United States, but also the UK and Spain and so forth. With so much of that excess savings sloshing around the world, it held down long-term interest rates. That produced housing bubbles, not just in the United States, but in many other countries. In fact, little-known fact, our housing bubble was not particularly large. Housing prices rose much more in Spain and Ireland and some of these other countries. Next slide, please. And finally, one factor that I think developed over time that contributed to this housing bubble was, frankly, political. Both major political parties in this country have had a long-standing philosophy that everybody in the United States should have the right to own their own home, which on closer examination is a rather silly statement. I know that when I was 25, I certainly should have owned a home. I could barely balance my checkbook, much less make a mortgage payment or have my roof repaired. And yet, this was the kind of thing that you could not criticize in Washington. And that resulted in two things. First of all, pressure on companies like Fannie Mae and Freddie Mac to make more low-income loans. And on the regulatory front, essentially turning a blind eye to some of the more abusive practices that end up putting people into loans that they could not pay back. So that gave us our crisis and a recession. I'll move on now to where we are now. There are two traditional models of recovery. Now, most of the business cycles that we went through in the post-war period, I would say followed what I call the bungee model, which basically means how far you come back depends a lot on how far you went down. The bigger the drop, the bigger the bounce back. Now, we've just been through a recession where the drop was on the order of 4% of GDP. The only other two recessions that come close were 73, 75, and 81, 82. And in the wake of those recessions, we grew around a 6%, 8% annual rate in the first 15 months coming out of recession. Well, we're clearly not doing that. We're growing more like 3% now. That's because we're following a different model, which I call the post-crisis model, which is more like an L or a U, where you grow much more slowly. Next slide, please. As to the debate as to whether it's a U, a V, or a U-shaped recovery, I think the debate has already been settled. The light lines you see here are the behavior of employment after every other recession in the post-war period. And as you can see from the solid line, we are performing far below the typical performance of the post-war period. So this is not a V. Next slide, please. Why is that? It's because financial crises, they don't just pound the economy down, but they leave lasting damage to the infrastructure of the economy. And so when the economy recovers, this loss of wealth and the damage to the financial system means that you do start growing again, but you essentially have a lot of difficulty getting back to the level of economic activity that you were on before you went into recession. Next slide, please. And in the very worst case situation, you end up like Japan, where you never really even get back to your old growth rates. You end up trundling along at these sort of stagnation type rates of growth. Now, I am not one of those who believes that we are in for a Japanese type scenario. You'll hear this talked about a lot, and I'll explain why. First of all, one thing that is often forgotten is demographics. If you look at these bars on the left side, Japan's population has actually been shrinking for the last 20 years or so, whereas ours has been growing. And that difference in population growth can explain a big part of why their economy has continued to do so poorly. I mean, it's really quite basic. How does an economy grow? Essentially the number of people and how productive those people are. If the workforce is actually shrinking over time, and as has been the case in Japan, that it's hard to grow. And moreover, there's a view in Japan that as the population has aged, it's become less risk averse, and so it's less dynamic, and that's obviously bad for productivity and for entrepreneurialism. The other piece of the puzzle is labor productivity growth. Japan grew very rapidly in the 3 decades after World War II because they were catching up to where the United States already was. Once you catch up, it's very hard to actually grow faster than the leader. And in fact, they have only grown as fast as we have with respect to productivity. And so for those reasons, I do not expect the United States to end up in a Japan-type situation. Next slide, please. However, it will be a tough slog, and this is the reason why. What does a financial crisis do? Well, I like to compare it to the electrical system. The financial system doesn't actually create wealth. It moves capital from savers to people who need capital, the entrepreneurs, the households, the businesses. And it's like the electrical wires. The electrical wires come down. You can't get the power from the generating stations to the people who use the power. And so the economy can't grow as fast. And that's more or less what happens when you destroy a piece of the financial system, as we have done. The banks don't have the capital or the liquidity to make loans. They're under pressure from their shareholders and their regulators to reduce risk. And they can't find creditworthy customers. People who borrowed money in order to buy homes, those homes are no longer worth as much as the debts they took on. They're either unwilling or unable to borrow, and it takes a very long time to work through that problem. And indeed, if you compare, this is an interesting little chart here. That red line is, these guys at the IMF, they basically looked at like over 80 business cycles in the last 30 years at over 20 countries. And the red line is the path of growth, not the actual level of growth. that you follow in the first 2 years after a normal recession, and the pink line is what you experience after a crisis. Now, as you can see, recoveries after crises are much weaker. The blue line in the middle is what the United States has actually been experiencing since our recession ended. And I think this is interesting because we're actually doing a little bit better than the typical post-crisis experience. So, you know, talking to some of you earlier today, a lot of people have mentioned just how unusual and uncertain the environment is. And that's understandable because this is not like a typical post-war recession recovery scenario. It is, however, typical of what a lot of countries have gone through. So what I'm trying to say here is that I think we do understand what we're going through. It is not some strange animal we've never seen before. It's going to be a very tough situation for the employment market. The chart that I just showed you implies that our growth rate will be in the 2.5% to 3% range for a number of years. Now, lately, that forecasts have been coming down, and some people are seeing growth of only around 2% next year. In my view, the pessimism has gotten a little bit excessive. I think we've swung too far from being excessively optimistic to excessively pessimistic. Yes, the recovery will be modest by historical standards, but it will still be a recovery. And that means the unemployment rate will come down next year, maybe, you know, by 0.5 percentage point. That's not nearly as much as we should expect. It should be coming down by 1 to 2 percentage points a year, but it will be coming down. Unfortunately, what happens is that when unemployment is very slow to decline, as you can see, a lot more people spend a lot longer period of time on the unemployment lines. And what happens is that the skills they have, they become obsolete. The work habits they had also atrophy. And a lot of these people have trouble going back to work later on, even as the economy recovers. And you can develop almost a higher structural level of unemployment. I mean, that obviously has huge human costs. I mean, these are people who can't work, you know, their incomes suffer. But it also acts as an obstacle to the vigorous growth of the economy. That's a major challenge to us, I think, in the coming years. This talks a little bit about the challenge of what we have to work our way through over the next 5 to 7 years. As you can see, as I mentioned at the outset, the atmosphere had encouraged people to take on more debt, more leverage, and so forth. But it really took off starting around 2000 when the housing boom began. People took on lots and lots of mortgage debt. As you recall, we were using our houses as ATMs, taking money out of our refinancing every 18 months, using the money to remodel or to go on a vacation or to buy a third car for our family. And we shot well above the trend line. And as you can see, it's now started to come down. Nobody really knows how far that number has to come down. We don't have a model that tells us what's the appropriate level of debt or what's the appropriate amount of interest people should be paying. But it seems like not a bad guess that we need to get it from, you know, 120% down to around 100%. If we follow the typical pattern of other countries that have had to go through these so-called deleveraging cycles, the entire process takes about 7 years. That means we'd be done around 2015. It's kind of a long slog. But what I've seen from the evidence so far is that we seem to be actually going a little faster than the average process, partly because I think that through some difficult decisions, including the TARP, including the bank stress tests, we forced the banks to be relatively aggressive at raising new capital, recognizing and writing off old loans, something, by the way, the Japanese never really did in their situation for at least a decade. And the saving rate, which had gone to almost to 0 a few years, is now up to 6%. So the good news is it looks like we've already got a lot of the heavy lifting done. And I think over the next 12 to 24 months, while we will continue to face these headwinds of people trying to pay down their debt instead of spending, they will diminish. And that's one reason I believe that the economy will do a little bit better than the pessimistic scenarios that you now see working around. But I won't kid you, I mean, there are some major structural changes that have to happen in our economy. For the last 25 years, this has been a classic consumer-led economy. If you add typical consumer spending to what we've been spending on housing, we went all the way from like 68% to 75% of GDP devoted to those two categories of spending. And it was obviously excessive. People weren't saving, they were spending, they were building homes. And where was the money coming from? Well, we were borrowing it from foreigners. You know, that's why we were running such a large trade deficit. The rest of the world came to look at Americans as the consumers of last resort. It couldn't last, and it didn't. This crisis was all about, you know, a big wake-up call to Americans telling us this